and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Briggs and Joann Spadigam. Okay, John, I'm going to start with you again because once again, it's been all about the US this week and another upside surprise in the data, which is signaling yet again more inflationary pressures. How does this fit with your view of rates, I suppose, in general?
Thanks, Imogen. Yeah, it looks like we haven't gotten any good news on inflation since 2023, to be honest.
And it
If you
feels
think,
that way too.
I know, it feels longer than that. But the number that you're referring to is actually because the timing of this recording, I should just clarify. This is we're getting the number that's part of the GDP number, the core PCE number. For the quarter, of which is the first quarter advance. Now, tomorrow we get the March data print, which is, obviously going to be included in that. So there's a little bit of noise here. We need to figure out, what does it mean for March? What does it mean? Is it more of a January, February? Our analysis, just from a high level, is that it probably is more impacting the path to March, which most listeners will have by the time they listen to this. So it does create upside risk for that. And given that, we also think that it means that inflation in January and February was probably higher than initially reported. Whatever that number is, again, which comes out on Friday after before this is going to be released, you'll be listening to this with already having it in tow. The point is the same, is that we have not just having more inflationary pressures than we expected in real time, so to speak, but we're even revising up the path to some degree. So whether that number is 2.7, 2.8, point is that the path, even looking back into January and February, which we were disappointed with, is even more disappointing than we thought initially. So it's just more hard yards when it comes to the inflation side of things. The market, as of now, has priced in only 34 basis points of Fed cuts this year. When we spoke last week, we talked about this level versus time thing, and how 2-year notes at 5%. If you've got the Fed policy range between 5.25 and 5.5, it might be hard to eat into 25 basis points of cuts this year because December's still far away, and there's a lot of months where we could see inflation turn around. And I don't want to totally eliminate the idea that we can get inflation turning around. I mean, if you think back to late December, inflation was surprising to the downside. Powell was pivoting dovishly. That's obviously all turned around, and that's the important part of what we're going through now. But 3 months from now, 4 months from now, we could be in a different story. Still, the way we framed it was on a simple front-end type metric. 25 basis points of cuts is probably the upside limit. You're 10 basis points from that, call it now. So 2s against 5.10, and there's some technical chart related levels there. That's probably going to provide some yield resistance, price support. Further out the curve, again, I just feel really ambivalent on it, because I think with the front end becoming relatively pinned, in theory, if that turns out to be true, pressure could spill out to the long end. And if you've got inflationary concerns and more term premium, inflation risk premium, arguably you could see that move kind of spill out into the back end. So I do think you're getting into levels that are attractive, but going back to that time component, we spoke last week, even before this change in the path to where we are today in inflation, we felt like time was your enemy, and it would take several inflation prints before you could get the bull steepening central bank easing theme back in train. That feels like that's even more accentuated today, given the data we're seeing.
Before today, it was obviously a little bit of a quieter data week, and globally that allowed or opened up the calendar to issuance becoming front and center again as well. We had lots of syndications or lots of issuance out of Europe, and then obviously the market's minds are looking ahead to the Treasury quarterly refunding announcement next week as well out of the US. What should we be watching for next week in that announcement?
Yeah, so it's interesting how we tend to worry more about supply and sell-offs than we do in rallies. If the Fed's easing, supply is being taken up isn't as much of a concern. But I do think that we are getting increasing questions about supply, so to speak, in the last week or so. And I don't think it's just the timing of the refunding. I think it's worries about deficits at a time where the Fed might not be easing, which totally agree with. For next week, there's a couple of moving parts, but I wouldn't say from an overall macro theme, there's going to be massive impacts. I mean, we're going to have some issues around bills. There's a little unpredictability on Treasury financing, so we're not sure what's going on with QT. So payments to the Fed, do they go up or down, or do they stay where they are? Or they go down more quickly if the Fed ends up cutting QT, call it in half at the next meeting to start in May, or does it announce in June to start July? But all that aside, that's really going to be caught up in fluctuations in bill markets. But I think the thing I would want to reference in relation to this is the question we always get is, when are coupons going back up? I mean, we know deficits are large. We know the government's not doing much to address them. And we were debating whether it was going to be November or February. To be honest, the way tax revenues have been better, they're up like 7.5% year over year, year to date, plus or minus. That number keeps moving because we're still getting tax information for the April 15th date. Revenues have been decent. We have a lot of questions going forward, but the main point I'm getting at is that November looks like we don't need to increase coupons and maybe even get through February. But when we look out to next year, and this is worth planting the seed for as time goes on, there could be another round of significant auction increases in coupon auctions, the point where 2-year note auctions, which are, say, call 69 billion now, could go up to 90 billion. I mean, these are like large scale increases, 5-year notes in that same kind of scale. For reference, in the early 23, 2-year note auctions were at 42. And we're looking at over a 3 to 4 year period, maybe those more than doubling. So there's real deficit issues that are going to come to the fore here down the road. So when people talk about whether it's term premium in the market, higher neutral rates, what should the shape of the curve be? I've been leaning towards steeper curves anyway because of a higher neutral rate, more inflation-prone economies, and this just adds another kind of weight to it. So do have some long-run concerns to the long end. The cycle will dominate. What's going on with the data will dominate, but it's worth planting the seed that this refunding doesn't necessarily have a lot of impacts now, but in the process of doing it, it's raising our concerns for the long term.
I guess then you have a lot of sympathy with the questions that we are getting around that long run supply outlook and the question marks around being able to service that debt, of course, at higher levels if the Fed isn't cutting rates or certainly isn't cutting as quickly as we thought, et cetera, et cetera.
Yeah, you've totally nailed that on the head. It's one thing if you think that policy rates are going to go back down to 3% within the near term horizon. But now if you're starting to talk about, and it's a reasonable question to ask, does the Fed maybe even need to cut? Or you certainly should be pricing in some sort of probability of that, which we are.
Mm.
That's not a tail risk anymore. It's non-zero probability, maybe 20%, that those questions become much more significant.
Yeah, that makes sense. Okay, Joe, let's switch over to Europe then. Let's start with the data. We obviously had flash PMIs this week. What's your take on what we learned from those?
We got another set of stronger than expected flash PMIs this time, and the service sector does continue to aid the recovery in Europe. We've been saying for a while now that we do think that growth in Europe should pick up, really led by the real income side improving over this year. And I think the PMIs are really showing us that that is the case and that actually growth should improve in the euro area in line with our expectations and also in line with the ECB's forecasts. I think what's interesting is that manufacturing has continued to be a bit weaker than services. But our thinking on manufacturing is that we do think that the forward-looking bits of the PMIs indicate that even the manufacturing sector should recover. So overall, we do think this improvement in growth will also slowly start to filter into the manufacturing side as well. I think what was interesting as well was that output and input prices within the PMIs had also increased and do remain above pre-COVID levels. But obviously, I think it's important to note that inflation before COVID was below target. So that's not necessarily something to worry about. There was some impact from the energy price increase over the last month, but we do think that absent of any other further shock, that inflationary pressures even within the PMIs should show a disinflationary trend moving forwards.
Sticking on the theme of the data then, I talked earlier about it being a relatively light data calendar and that opening up a window for supply, but Europe probably is one of the, or will have one of the data highlights next week in the sense that we get the inflation print. Are you expecting this to be particularly market moving?
So our expectation for the euro inflation print for next week is for 2.3% on headline, so slightly lower than the previous month, and 2.6% for core, so a pretty sizable drop there. I think it's interesting on what the market reaction would be to a hit or miss. At this stage, I think the ECB has made it fairly well known already that in this last stage of getting to 2%, they're not really expecting it to be a smooth ride. They're expecting it to be a bit of a bumpy ride. So I think, to me, even with our forecasts, which are slightly below market expectations at this point, I do think that the ability or the market reaction from a small downside or upside surprise should be fairly limited at this stage, just because the ECB has telegraphed that they don't expect it to be a smooth ride. So a small deviation to me doesn't really bring about a market change in the way in which markets are pricing things at the moment. European pricing has already moved quite a lot in line with US market pricing for cuts. So I do think that you would need a fairly large surprise in the data to get a significant shift in expectations for ECB cuts, particularly given that now markets are pricing in a bit below 75 basis points in cuts, which is in the more hawkish end of our expectations for cuts for this year. So I do think that if we do get a small upside surprise on this print, I would find it difficult to see that a market repricing at this stage, given that the US has already done quite a lot of the work in Europe already.
And then finally, I guess, very kind of similar question to you around the supply outlook, because that was clearly the other theme driving markets this week, perhaps most clearly so in Europe. It felt like the heavy supply schedule was part of the bear steepening that we've seen. How do you expect the shape of the curve to shift going forwards with, I suppose, one eye on a still very heavy supply schedule?
It's pretty interesting. I think on Wednesday we had a day where there wasn't too much going on, but we did see a fairly significant bear steepening that, as you said, Imogen, has been led by supply. There was a Greek syndication and 10-year bond supply on the day, so that could have aided that move as well. But I think that what we're seeing with the bear steepening is really indicative of what I think will happen through the rest of the year, where supply will continue to weigh at the back end of the curve. There's been a lot of focus recently on the front end and what the front end means for the curve, but I do think that maybe markets do become a bit more complacent about supply, with lots of focus on the front end and lots of focus on what central banks are going to do. So, I think for the rest of the year, we still have plenty of supply to get through. There's still more than 700 billion in terms of gross supply to get through this year. So I do think supply will be a theme that continues to weigh. We've got, obviously, the ECB stepping up PEP as well mid-year. So I think overall the supply picture is a theme that will continue to dominate through this year, even once we get through the ECB cut in June, or when is a Fed cutting kind of narrative that we've been talking about for the last few months. I think supply will continue to be a dominant theme and should really focus or add to our conviction on this curve steepening view that we've held for quite a while. Enough of me on the euro. I think let's move to the UK now. So, Imogen, I think the key focus and the key highlight for this week in the UK domestic calendar was Hugh Pill speaking. So what's your take on his comments from this week?
Yeah, I guess it was a quiet kind of calendar anyway in the UK, but Hugh Pill we think of as being, quite influential, I suppose, in terms of leading that sort of centrist bloc and the way that they, of the MPC, and the way that they think about monetary policy. But also, given that we hadn't heard from him as the chief economist of the Bank of England for at least 6 weeks since the beginning of March. It was a kind of much anticipated speech to understand how his views may or may not have changed since then. We've obviously seen, another couple of months of data, and the market has moved significantly. But actually, I think the kind of high-level takeaway, or the short conclusion from what he told us in his speech this week, was that actually data has evolved broadly in line with the Bank of England's expectations. As we know, headline inflation finished the quarter slightly below, not to overstate, but slightly below their projections. Wage inflation probably slightly above. But broadly speaking, data has evolved very much in line with the Bank of England's and kind of city economists' expectations in Q1. And that the passage of time since he last spoke 6 weeks ago puts us a little bit closer to a rate cut than we were 6 weeks ago. But we're not reaching that point of a rate cut any faster than he thought we might at the beginning of this year. So I think you can call his speech a kind of incrementally dovish shift in that, he talked about being a little bit closer to a rate cut and data being in line with expectations, which I guess implicitly you're less worried then about the upside risks in the data as it becomes better behaved and more in line with their projections. But it's, not as much of a dovish shift as we saw from kind of traditionally more hawkish Ramsden last week, for example. I think for us and for markets, the takeaway is really that it just reinforced our long-held view, that August is our base case for the first rate cut from the Bank of England. Two key sentences that I think, wouldn't have made me think that rate cuts were coming any earlier in his speech, which I've actually written down because I think it's important to highlight these, is that he talked back at the beginning of March, his kind of catchphrase was that he thought that rate cuts were still some way off. And that has now evolved into being, we still have a reasonable way to go. Now, that doesn't sound particularly imminent. I'm not sure that a reasonable way to go from the end of April certainly rules out May in my view, but it doesn't necessarily bring June into focus either. And that was reinforced by the fact that he then said, for me, the hurdle to changing my assessment of inflation persistence over the coming few months is relatively high. We spend, I think, probably more time than we would like to admit on the desk debating how much a few really applied to. But, whether you think it's 2 or 3 or more than 3, in any case, from the end of April, that takes us to beyond June as well. So we're comfortable still with our August call. And I think the near-term implications of Hugh Pill's speech this week, given that it's likely now that that's the last that we will hear from any Bank of England speaker ahead of the quiet period next week before the May MPR, the monetary policy report. And also, like I say, as one of the more influential members, and particularly as the chief economist, as the data becomes very important in timing that policy pivot, I think it's difficult to imagine that you're going to get a major shift in the forward guidance at the May meeting. To get a shift in the guidance in terms of signaling a more imminent rate cut, you would need the majority of the committee to kind of ascribe to that view. And it still feels to me like you're some way away from that, or some way off, as Phil would say. And so, I think that means that markets are still, really mispricing the pivot. And the biggest mispricing to me, or misconception in the market, continues to be this kind of obsession in the UK with just following exactly what US rates are doing, essentially. The UK has been far more reactive to US central bank speak and US data than it has been on anything domestically, given that, fundamentally nothing has really changed domestically. Like I say, the data, broadly speaking, in Q1 has been almost exactly in line with expectations. And yet we've done, a 100 basis point almost round trip in terms of bank rate pricing. The biggest mispricing for the market, to me, continues to be in terms of the scope of easing being priced rather than that timing. Actually, now the timing of the market's rate cut profile doesn't look that wrong. It has very little chance of a cut in May, less than 50-50 chance of a cut in June, and then a full 25 bip rate cut almost fully priced by August. That's in line with the way that we see the balance of probabilities for the next couple of meetings. the mispricing then is how much easing is priced beyond August, or really just in the second half of the year. If the Bank of England is able to cut rates by June or by August, I think that is the start of a series of rate cuts, regardless of what is happening in the US, regardless of what the Federal Reserve is doing. And so the market only having in one additional rate cut beyond August feels far too low to me. And actually, I think that although Hugh Pill's speech, I think, was easier to rationalize than the shift in view from Sir Ramsden last week, that was one interesting takeaway from his speech was, he talked about the fact that for a while at the end of last year, the UK inflation outlook looked quite different to its global peers, and the MPC was perhaps overly concerned about the risk of these persistent inflationary pressures, and they ended up hiking rates an additional 50 basis points when that wasn't what other central banks were doing. And he even put the chart in and kind of circled that 50 bip hike, almost as if to say, we over tightened back then. Reading between the lines, I think what he was telling us is that they're comfortable that they over tightened back then, and therefore, they can easily deliver a kind of 75-100 bits of easing this year, I think. A, and policy will still be restrictive, but B, perhaps more importantly, regardless of what the Federal Reserve is doing. And I think that's been one of the key takeaways from generally Bank of England speak this over the last couple of weeks, is that the UK is not the US. And I'm really just waiting for markets to wake up and realize that too. Perhaps the June ECB meeting is a key moment in markets being able to price a bit of policy divergence once it realizes that actually the ECB can cut before the Fed, can cut maybe twice or even 3 times more before the Fed go. But that feels a long way off still.
So a fairly quiet data calendar week as well. I think in the UK there was also some focus on supply with a long end syndication as well as the gilt remit revision. So what's your take on that, and how do you think about gilts and fair value from now onwards?
Yeah, so we had the remit revision as is usual at towards sort of mid to end April, and we had expected a 6-ish billion revision upwards to gilt funding requirements in this fiscal year, and actually the outturn was almost 12.5 billion. So a fair amount bigger than we were expecting, albeit small in the context of overall issuance this year. That brings gross gilt funding up to just shy of 280 billion in this fiscal year. So an additional 12 billion isn't, game changing. So it doesn't really change how we think about that level of fair value. We have this long held fair value target of 4%. It feels like 10% at the moment. Probably be there before we get back to 4. No, of 4% in 10-year gilts. And like I say, this 12.4 billion is, doesn't move the needle on that. But I think it does reinforce our view that 4% can be held as a kind of fair value target, even in an environment where the Bank of England is cutting rates much quicker than than the market is currently expecting. 100 basis points perhaps this year, maybe an additional 75 next year, and that will keep this sort of supply demand imbalance will keep gilt yields elevated even in that monetary policy easing cycle. And I guess very similar to what you were talking about, Joann, it kind of reinforces our view that the curve should be steeper. I thought it was an interesting dynamic this week that the euro area spectrum was able to bear steepen so significantly, and gilts kind of lagged behind. And yeah, I think the case for the supply demand imbalance to weigh heavier at the long end of the curve is clearest in the UK, where although the proportional buckets have been shifted smaller, there's still plenty of long end supply to come, but we've had the biggest structural shift on the demand side, in terms of the natural players kind of stepping away at the long end of the curve, and that gap being filled with demand at the front end of the curve, but supply still being relatively evenly distributed all the way across. So I actually think perhaps you could see some underperformance of the long end of the gilt curve versus the euro area, for example. And ultimately, I think that the UK curve should out-steepen. But similarly to everything that John was saying around, it being a question of level versus time, the same very much holds true in the UK. I do think that we eventually trend back down towards our fair value target of 4% in 10-year, and we eventually see steeper curves, but I'm just not 100% sure what the catalyst is for that in the very near term. Anyway, that's probably enough from me. Thank you both for joining me this week. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.